Hello and welcome to the second part of joint venture accounting. In the previous video, we have learned about the meaning and definition of joint venture and salient features or peculiarities of joint venture accounting. It's time to learn more about joint venture accounting, and let's move on to the first method, which is recording the entries related to joint ventures under separate set of books. Before proceeding further, it's time to take a quick look of what we have learned so far. In the previous video, we have talked about the meaning of joint venture, and we have spoken about the comparison of joint venture with partnership. Then we have highlighted the salient feature or the peculiar characteristics of joint venture, which makes it a different segment of accounting. And then we have talked about the accounts that are used in doing the joint venture accounting. Alright, so we stopped at the methods that are to be followed in doing the joint venture accounting. So let's start with the first method of doing joint venture accounting, that is maintaining the separate set of books for joint venture. To start with, it is important to know the suitability of this method. This method is suitable for large-scale projects, which involves large volume of financial transactions, which are to be taken care of in a separate manner. Then, the projects which are of longer duration, that means they are exceeding 1 financial year. And the accounts maintained under this method includes these accounts. First one is the joint venture account, which is same as that of profit and loss account, and it helps in computing the profitability of the venture. Second, like partners account, we maintain the personal accounts of the co-venturers also. And the nature of this account is same as that of the creditors account. And then we maintain the joint bank account. Since I told you that this method is suitable for large projects, then the involvement of financial transactions and the volume of financial transaction is much more. So they should be properly accounted for with a separate bank account called the joint bank account. And we may maintain some other accounts as per the requirement of the venture. Let's take a closer look to the accounts that we are going to maintain for the joint venture under separate set of books. So the first account is joint venture account. The joint venture account is prepared to find out the profit and loss of the joint venture. For this, the nature of account is a nominal account. That means debit all losses and expenses, credit all incomes and gains. Right? So the debit side of the account constitutes all the cost and expenses related to the joint venture. And the credit side includes all the income that is coming out from the sale or the completion of the contract, or realization means if you are selling the material at some cost, or you are selling the assets of the joint venture before dissolving it, or that it also includes the takeovers by the co-venturers, or any goods if destroyed and they are sold, then the scrap value or the sales value of those damaged goods and claims related to that are also accounted for in the credit side of this account. So the net results after taking into account the expenses and incomes related to joint venture is the net profit. When does the net profit comes? If the credit side exceeds the debit side. And consequently, there will be a loss if the debit side is more than the credit side. It is important to take a note that there is no separate treatment of abnormal loss. Since the joint venture is an agreement or is a business activity undertaken for a shorter duration of time, so everything is perceived in short span. That means either as an expense or as an income. So abnormal loss, the portion of abnormal loss is already charged to the debit side at cost, and suppose anything is realized or not realized will be shown on credit side according to the settlement of that loss. So it is automatically settled in the joint venture account. So there is no need of separately accounting for abnormal loss. Co-venturers account. Now, co-venturers, the position of co-venturers is same as that of partners in partnership business, partnership accounting, right? They are responsible for contributing capital, they are responsible for conducting or completing the joint venture, and they are the ones who have final claims on the profits and losses of the joint venture. So let's have a look at the co-venturers account. The purpose of preparing co-venturer account is to see the capital contributions made by them, to check on the withdrawals that they have made during the joint venture, and to finally understand what is the claim that is due towards them or due from them. The nature of this account is that of a personal account. And what's the rule of personal account? Personal account says that debit the receiver, credit the giver. Ideally, the position of co-venturers in joint venture is that of a creditor. So this account is prepared with the rule of a creditor. So whenever they contribute anything for the business is recorded in the credit side. So their capital contributions, any supplies of material or asset is recorded in the credit side of their respective accounts, and expenses incurred by them on joint venture are also recorded in the credit side, plus their share of profit from the joint venture. The debit side of co-venturers account contributes whatever they have taken over or withdrawn from the joint venture, be it material, be it assets. If they have made a sale and kept the sales proceeds with them, so that will also be recorded in the debit side of the co-venturers account. The net result of this credit side will be greater than the debit side. Then this indicates that the joint venture cash is due towards them, means finally their claim will be settled by paying them cash. And if the debit side means they have overdrawn, right? So the payment will be made by the co-venturer to the joint bank account for making over the excess withdrawal. But that's a rare situation. The important thing to note about this is, if joint venture is ongoing, there will be a carried down balance. We are not going to close it against the cash settlement on to and by side. Ideally, it will be the balance carried down on the debit side, because the credit side is usually heavier than the debit side. Now, joint bank account. The nature of this account is same as that of the bank account or cash account that we have learned in the financial accounting. So the purpose of this account is to keep a separate record of all the receipts and payments related to joint venture. Then the nature of this account is same as that of a real account. That means debit what comes in, credit what goes out. So when the money comes in to the joint venture, it is recorded in the debit side of joint bank account, and anything which is paid out of joint venture like expenses or any other thing, then that is recorded in the credit side of the joint bank account. So debit side constitutes the receipts of joint venture, and credit side is made up of payments of the joint venture. The net result is, when the project is completed, there will be no balance, means debit is equal to credit, right? As we have seen in case of dissolution, we make the cash account or the bank account at the last, and finally when all the claims are settled and the business is closed, automatically the cash balance becomes zero. So same, when the joint venture is completed, there is no balance. You will find debit side of the joint bank account will be equal to the credit side. And if it is an ongoing project, then there will be a buy balance carried down in this account. Now comes the fourth category of account, that means other accounts. We have not specified anything because it is as per the requirement of the joint venture that these accounts will be maintained. They might be related to any payment which is outstanding towards any purchase, or any payment which is due from a debtor to whom this credit sales has been made. So these accounts are made as per the need of the joint venture. Now it's time to learn the journalizing of the transaction of joint venture. Let us see all the categories of transactions that takes place in a joint venture and how they are accounted for. So this is the transaction description. That is the debit account which is getting affected, and that is the credit account. So let us see the transactions of joint venture. Any business or any venture starts with the capital contribution. So whenever the partners contributes capital, how is it recorded in the books of joint venture? Joint venture account includes three important accounts. One is joint bank account, the other one is joint venture account, and the third one is co-venturer account. Capital contribution is made by the partner, so cash is coming in and the partners are contributing the capital. So accordingly, joint bank account will be debited and co-venturers account will be credited, just like partners capital account. The second transaction is of purchase. Now, to start the business or to run the business or to conduct the business activity, we need to purchase the material, we need to purchase the asset. The same entry is clubbed together when for the joint venture asset is purchased material is purchased by paying cash. And there might be a situation when these assets and material are supplied by the partner. And it might happen that no cash payment is made for their purchase, it is purchased on credit. So let's see how are we going to post it. The entries will be separate, but your understanding should be same. Everything which is charged on the joint venture, or which is any expenditure which is made on the joint venture, should be debited to the joint venture account. Any expense incurred on joint venture. So this is the cost of material, this is the cost of asset. So as per the nominal account rule, debit all expenses and losses. So this is a cost or this is an expense on joint venture. So joint venture account will be debited for this purchase. And if it is purchased for cash payment, then on credit side you will have joint bank account. But if it is supplied by the partner, so instead of bank you are going to write down the name of co-venturer, whoever has supplied the material or asset, in the credit side. And if the third case, it is purchased on credit, so the name of the creditor will appear on the credit side. Now to sum up this transaction, where the asset and material is purchased either for cash or supplied by co-venturer or purchased on credit, the transaction will be joint venture account debit with the value of purchase to joint bank if it is purchased for cash, to co-venturer if it is supplied by the venturer, or to creditor if it is purchased on credit. Now the third category of transaction, when you run a business, when you do a business activity, you tend to make the expenditure. You have to incur the expenditure in order to run that activity. Similarly, when the joint venture is run, there are expenses related to joint venture which are paid either through the joint bank account or they are paid by the co-venturer on behalf of the joint venture. So what is the entry for this? Again, we are going to debit the joint venture account because this is an entry related to the expense on joint venture. And on the credit side, if we are paying it from joint bank account, so we'll write down to joint bank account. But if this expense is incurred by the co-venturer, we are going to credit his account with the value of expense he has paid. It's like co-venturer incurring an expense which will be reimbursed to him later on. So this will be written to his credit, whatever expenditure he make on joint venture. So the entry for expenses paid or met by the co-venturer on behalf of joint venture, the entry is joint venture account debit to bank if the expenses are paid from the bank, and to co-venturer's account if the expenses are paid by the co-venturer. Every business is undertaken with an objective to earn money, to earn income. So is the purpose of joint venture. So the income of joint venture, which is recorded as sale of the joint venture or the fulfillment of contract and receiving the contract money. So the income of the joint venture is recorded in this manner. The money comes into the bank, or if it is sold on credit, then the debtors comes into the book. So the entry is joint bank account debit or debtors account debit to joint venture account, because it is the income of joint venture. Then other than this, if there is some claim received for damaged goods, or if it is sale of scrap, or it is some material which is sold or some asset which is sold for some value, then all that is seen as an income of joint venture. So you record it as joint bank account for receiving the money on behalf of this transaction and to joint venture account. So the transaction for anything other than the major sales activity, whatever cash you realize, you record it in the same way as joint bank account debit to joint venture account. Continuing further, if the expenses are made, then income is earned, then the last thing is to wind up the things. So if there is any closing stock of the joint venture and it is an ongoing joint venture, then the entry is joint venture stock account debit to joint venture account. Like you show the closing stock in the credit side of trading P&L, similarly you are going to show it in the credit side of the joint venture account because it is also a nominal account. Then the result of all this is the net profit or net losses. So when the net profit comes, that means the debit side is smaller than the credit side. So you are going to write down joint venture account debit to the co-venturer account because this profit belongs to the co-venturer. So it will be distributed between the co-venturers in the ratio of their profit share. And if there is a net loss, then the entry is just the opposite. Co-venturer's account will be debited and the joint venture account will be credited. And lastly, the final settlement of co-venturer is if the joint venture obligation is over, if the joint venture is complete, fulfilled, then the closure entry in which we are going to pay back the money to the co-venturers will be co-venturer's account debit to joint bank account. Let's take a closer look to the ledger accounts. Joint venture account. In joint venture account, we are going to debit all the expenses that we incur on joint venture, and we will credit all the incomes on the credit side, and the result of the two is the net profit or net loss, which will be either credited to the co-venturer's account or debited to the co-venturer's account. Now the co-venturer's account, it is credited for all the capital contributions made by the partners. It is credited for all the supplies made by the co-venturers, either for the expenses or for material or for the assets. Whatever they supply for joint venture is credited to their account, and they are debited for the assets, material, whatever they have taken over, and it is debited for their losses where the profit is shown in the credit side. And finally, their claims, if we have to pay them the claim finally, so that will come on the debit side, and if they have to recover something from the co-venturer, it will appear on the credit side. Now it's time to understand these accounting fundamentals numerically. This is a situation for you to understand the separate set of books with the help of these facts and figures. This is a situation where A and B are the co-venturers who have entered into the joint venture of selling the cotton shirts and sharing the profits and losses in the ratio 3:2. For the purpose of joint venture, they have opened a joint bank account in which they have contributed 40,000 and 50,000. 40,000 is the contribution made by A and 50,000 is the contribution made by B. For bringing the cloth or for purchase of the cloth, they are spending 30,000 and they are spending 2,000 for the cartage. For stitching the shirts, they have purchased an asset called the sewing machine for 25,000, and for the labor, they have paid wages of 20,000. Just keep a note of it and then we will proceed. There are certain expenses which are borne by the co-venturers. A has paid 1,500 as the advertising expenses, whereas B has paid 2,500 towards the miscellaneous expenses. The shirts were sold for rupees 1 lakh. So 1 lakh is our sales revenue. And the money is deposited in joint bank account. A took over the material, so there is a takeover by the partner. How much? There is a stock of 5,000 which is taken up by A and a stock of 3,000 which is taken up by B. They have sold the machine for 15,000. So that brings an end to the joint venture, and we have to take into account all these transactions that have taken place. So here we go. As you remember, the joint venture has started with the contributions made by A and B in the joint bank account. So they have opened a joint bank account. So the entry is joint bank account debit to the partner's personal account, to A's account, to B's account. And the respective contribution is deposited in the bank. 90,000 is the total contribution, which includes 40 from A and 50 from B. So this is the capital contribution for opening the joint bank account. And then the second entry, that they have purchased material and paid the cartridge. So this is an expense on joint venture. So the joint venture account is debited for this expenditure and the money is paid. This is not supplied or this is not purchased on credit. So the money is paid from the joint bank account. So total 32 means 30,000 for the cloth material and 2,000 cartridge. So that makes a total of 32,000 expenditure on joint venture. The third entry was the miscellaneous expenses of 2,500 paid by B and 1500 advertising expenses paid by A. So we have to take a note of it. This is an expenditure of joint venture, so joint venture account debit. But who has done this expenditure? It is the co-venturers. So we'll give them a credit for doing this favor for joint venture. We are going to settle this money in their final claim, so we are giving credit to their respective accounts. So the entry is joint venture account debit to the total expenditure of 4,000, whereas we are mentioning on the credit side A's account for 1500 rupees spent by him and B's account for 2,500 spent by him. Then the fourth transaction, where the machine was purchased and the wages were paid, right? So these expenses were paid for joint venture. They will be debited to the joint venture account, and since the money is already paid for it, so joint bank account will be credited for the payment. So the entry is joint venture account debit to joint bank account, and this 45,000 includes 25,000 for the purchase of sewing machine and 20,000 for payment of wages. Is it clear? So we are recording joint venture account on the debit side for all the expenses either paid from the bank or contributed by the partners. So to sum up the transaction up to here, we are debiting the joint venture account for all the expenses and costs. We have purchased the material and we have paid the cartage, so we have debited the joint venture account. And since the payment is made, so we have credited the joint bank account for the payment. Then there are some expenses which are met by the partners, so we have debited again the joint venture for the respective expenditure and we have credited it into the partners or co-venturers account. Now there is a sale of shirts for rupees 1 lakh. Let's take a record of it. So it's an income of joint venture, so joint venture will go to the credit and the money is deposited in joint bank account, so the bank account will be debited for the receipt of this 1 lakh rupees. So the transaction is joint bank account debit to joint venture account for the amount of sales. Now there is a takeover of material by the co-venturers. So for the takeovers, we are going to debit the accounts of the co-venturers for whatever they have taken from the joint venture. So A's account debit for 5,000 worth of material that he has taken. B's account is debited for 3,000 worth of material which he has taken over, and this is charged to the joint venture account as the part settlement of partners. Then finally the sewing machine was sold for 15,000. So this entry will be recorded same as that of sales. So the entry is joint bank account for receiving cash on the sale of machines to joint venture account. This will be treated as the income. See, joint venture account, it sees all the things, all the transaction with the perspective of either expense or income. You do not segregate it from revenue, capital, etc. Everything is seen in short-term perspective, because the basic purpose of joint venture is to take an advantage of a business activity or do a specific business activity for a definite time period. So since the longevity is not more, there is no capital and revenue bifurcation in case of joint venture accounting. It is seen either as income or as an expense. Once we have recorded all the expenses and incomes related to joint venture, it's time to calculate the profit and losses. In this case, there is a 42,000 rupees profit on joint venture after recording all expenses and income. This will be distributed between A and B in the ratio 3:2 as specified in the question. So the share of A is 25,200 and share of B is 16,800. And now the joint venture will be settled by calculating the total claims of the partners that they are going to take away after the closure of joint venture. So this is A's account. A's share is coming 61,700 and B's share is coming 66,300, which has been paid from the bank as total 1,28,000. Let's make the joint venture account now. Joint venture account will be debited for all the expenses, whether it is related to purchase of material, whether it is related to payment, and whether it is the expenses met by the co-venturer. So let's take a closer look to this. Firstly, the material was purchased, so joint bank account is written on the debit side of the joint venture account for purchase of cloth and cartage. The description is given in the internal column. Total 32,000 worth of material and the expenses are recorded in the debit side. Then there is a payment of 20,000 wages and a purchase of 25,000 worth of sewing machine, which is again an expenditure on joint venture. So we are recording it again on the debit side for payment of wages and sewing machine from joint bank account, right? And this 45,000 comes as the total expenditure which is made for joint venture again. Now there are certain expenses which are paid by the co-venturers, but they are the expenses of joint venture, so they are recorded in the debit side of joint venture account, but in the name of co-venturer, because this money is not going from the joint bank account, it is being paid by the co-venturers. So we have recorded how much A has spent, 1,500, and how much B has spent, 2,500. So a total 4,000 also comes into the debit side of the joint venture account. Moving on to the credit side, there is a sale of 1 lakh worth of shirts. So anything which is an income of the joint venture comes in the credit side. So this money is being credited into the bank account. So 1 lakh is recorded in the credit side of joint venture account against the sales. Then there is a takeover. Takeover is also treated as the income of the joint venture because this much of claim of the partners will be reduced. So co-venturers account, in the name of co-venturers, we have written the takeovers. A has taken 5,000 worth of material and B has taken 3,000 worth of material. Total 8,000 is also recorded in the credit side of the joint venture account. Lastly, there is a sale of machine for 15,000. Whether it is the main sales of the business or it is the sale of the asset or it is the given away of material, everything is recorded as the income of joint venture. So we are again showing it on the credit side of joint venture account as the money is received for the sale of machinery, 15,000 rupees. Now, once all the transactions are recorded, we have calculated whether there is a net profit or there is a net loss. So in this case, we are getting a profit of 42,000, which is to be distributed in the ratio 3:2 between A and B. So here is the share of A and B, 25,200 and 16,800. Now it's time to prepare the co-venturers account. We prepare it in the same format as that of partners capital account, right? So to start with, the first sentence of the question where the partners are contributing 40,000 and 50,000 to open a joint bank account. So their capital contribution is recorded in their credit side, right? So we are showing by joint bank account 40 and 50,000, which is the contribution made by A and B. Then secondly, they have incurred the expenses of joint venture. Again, they will be credited for this thing. So we have recorded by joint venture account and their respective contributions that they have. Whatever they are bringing in, whatever they are doing for the joint venture is recorded to their credit. Then they are taking away something from the joint venture also. So we have recorded that takeover as 5,000 and 3,000 on the debit side. This settle their claims by this much of value. Instead of cash, they have taken material of this much worth, right? So this is shown as a payment to them. Finally, we have credited the share of profit to their account, and that finally sums up their value as their final settlement, 61,700 for A and 66,300 for B. And since it is a completed joint venture, it's time to settle the joint bank account. It started with the receipt of money from A and B, so it is recorded in the debit side as receipt. It is prepared with the same fundamental as we prepare the cash account or bank account, right? So the fundamental remains same. Then there is an expenditure related to purchase of material and payment of cartage. So on the payment side, we have mentioned 32,000. Everything is incurred against the joint venture account on to and by side except for the capital contributions or any payment made to a specific person, right? All the entries of joint bank account are against the joint venture account, right? Then there is a payment of wage and purchase of machinery that is again recorded against the joint venture account. Then the sales that has been made and the money is received for joint venture sale is recorded in the debit side as the receipt, and then the machinery sold is also recorded as the incoming of cash in the joint venture. Finally, whatever remains is the share of A and B which is being cross-posted from their account. So these are the shares which is to be given to the co-venturers, and this equalizes the debit side and credit side automatically. So these are the three important accounts that we have to make under separate set of books. So we have seen joint venture account, which is a nominal account to find out profit and loss on joint venture. Then we have made co-venturers account, which tells you about the claim of co-venturers towards the end of the joint venture, or whatever is their balance carried down if it is an ongoing project. Then finally, the joint bank account, which shows the receipts and payments which are made on joint venture. So this is the complete record under separate set of books. So this was all about the separate set of books. In the coming video, we'll be going to talk about recording the joint venture entries in the books of any one of the co-venturer or all the co-venturers. Stay tuned for the next video.